Thank you for joining today's real estate webcast entitled Commercial Real Estate Outlook. Is there cause for optimism? Before we begin, I'd like to take a moment to highlight some of the features of today's event. You can ask our presenters content-related questions at any time by entering your question in the box at the bottom of the screen and clicking Submit. Use the links in the lower right-hand corner of the screen to download and print today's slides as well as request CPE credit. If there are several people viewing from a single location, each person will be able to register for their own CPE credit following the webcast. According to National Association of State Boards of Accountancy guidelines, you must vote in at least 3 of today's poll questions and watch for at least 50 minutes to receive CPE credit. CPE certificates for eligible viewers are available for download immediately following the webcast by clicking the Request CPE link. You can read presenter bios, view the agenda, and access technical support in the navigation area on the left of the screen. And now I'd like to introduce our host for today's webcast, Bob O'Brien. Bob leads Deloitte's U.S. Real Estate Services. In his role as U.S. Real Estate Leader, Bob is responsible for the group's overall strategy and execution across all aspects of the real estate, home building, engineering, and construction industries. Please welcome Bob O'Brien.
Thank you, and good day, everyone. Glad to have you with us again for our latest Debrief Real Estate Series event. Today's topic is Commercial Real Estate Outlook, Is There Cause for Optimism? And our debrief today is based on a publication recently done by the Real Estate Research Corp, Deloitte's Financial Advisory Services Practice, and the National Association of Realtors, entitled Expectations and Market Realities in Real Estate 2012, New Foundations in an Uncertain World. That publication can be found on our websites. I suggest going to the Real Estate Research Corp website to find a copy of that. Let me introduce our speakers today. First, Lawrence Yuen is Chief Economist and Senior Vice President of Research at the National Association of Realtors. He directs research activity for the association and regularly provides commentary on real estate market trends for its 1 million Realtor members. Dr. Yuen creates NRR's forecasts and participates in many economic forecasting panels, including the Blue Chip and the Harvard University Industrial Economist Council. He appears regularly on financial news outlets and is a frequent speaker at real estate conferences throughout the United States. In 2008, USA Today listed him among the top 10 economic forecasters in the country. Dr. Yuen received his undergraduate degree from Purdue University and earned his PhD from the University of Maryland at College Park. Let me introduce Matt Kimmel, who's a principal and our real estate industry leader for Deloitte's Financial Advisory Services practice. He's also a national leader in the real estate valuation practice, as well as the Tangible Asset Advisory Services team, which offers cost segregation, equipment valuation studies, construction, and lease advisory services. Matt has over 30 years of real estate consulting and valuation consulting experience and is well-versed in a variety of valuation issues concerning both national and international markets. He's also testified numerous times as an expert witness. He holds a BS in construction engineering from Purdue University. So for those of you keeping score, that's 2 Boilermakers on this debrief, and has studied accounting and economics at a graduate level at Loyola University. Matt has been quoted in the Wall Street Journal and published by the Wharton Business Review. Finally, let me introduce Ken Riggs. Ken is Chairman and President of Real Estate Research Corporation since 1991. He directs RERC's research, valuation management, independent fiduciary consulting, and web-based management information services for a variety of institutional clients. In addition to leading the firm's business ventures, Ken serves as a publisher of the RERC Real Estate Report and the RERC CCIM Investment Trends Quarterly, and is co-publisher of the annual forecast report we're discussing today. He also serves as the 2012 Chair of the Counselors of Real Estate. Ken holds an MBA with a concentration in finance and statistics from the University of Chicago Graduate School of Business, and holds a number of professional designations, including CFA. He's a member of the Fellow of the Royal Institution of Chartered Surveyors. He has a CCIM designation from the CCIM Institute and the MAI designation from the Appraisal Institute. With that, let me, if I could, turn it to the first polling question. What is your view of the commercial state or the current state of commercial real estate? Do you believe a robust recovery is underway? We're in the early stages of a gradual recovery. It's flat and sluggish. Uncertainty prevails, could go either way, or poised for further deterioration. While we wait for your responses to the survey question, let me briefly provide an overview of our agenda for the discussion today. Lawrence will walk us through the economy and the investment environment, and then we'll turn it over to Matt, who will provide us with a mergers and acquisitions update and a discussion around property fundamentals in the various real estate subsectors. And then we'll turn it over to Ken for capital markets outlook. Finally, we'll leave some time at the end for questions from you. We've got a lot of content, so we may not have a chance to get through a lot of questions. But if you do have questions based on what you're hearing today, please send them in using the tool. With that, why don't we turn and take a look at the responses we got to polling question number 1. Well, a mix of answers, and the largest group thinks we're in the early stages of a gradual recovery, but certainly I think the variety of answers and the answers to the uncertainty question would certainly support that there still seems to be a significant amount of uncertainty in the environment today. I hope you find Deloitte's debrief today insightful and enlightening. Let me turn it over to Lawrence for his insights on the economy and the investment environment. Lawrence?
Thanks, Bob. And good day, everyone. I'm glad to join you. Looking at this past decade is without a doubt is a decade of the housing market cycle, the unprecedented heavy activity during the bubble years and then subsequent 6 years of a decline, or I should say more specifically, there was a precipitous decline in 2006, 07, 08, and then it has flatlined, but that flatline trend has been at the very low point, sales activity roughly matching up with the early 1990s time period, and from housing's point of view, indicating that despite the population growth that occurs in the country, so we do know that it is a cyclical business, but nonetheless, every year 3 million people, every decade 30 million people, that current sales activity would clearly imply some level of underperformance in relation to the population that we have in the country. So it has been quite a tough 4 years for the housing market and for our realtor members. And as Ben Bernanke constantly mentioned, it is the housing market recovery that needs to take place to assure that we have a solid, sustainable economic growth. Moving to the next slide is the price situation, and there are different price metrics, and I am going to focus on the one that the media focuses most on, which is the Case-Shiller Price Index, looking at the 20 market weighted average of the 20 market. This chart also shows the bubble years and then subsequent crash, but note that from 2009 that home sales, home prices have also been flatlining, meaning little up, little down, no major changes. So the prices have come down, but the recent declines, past 3 years of declines, has been very, very modest. The cataclysmic declines were in the early years of the housing market crash back in 06, 07, 08, but since that time it's been somewhat stable. Now, one reason for the beginning stage of the stability was the home buyer tax credit that was introduced, which brought in some buyers who were sitting on the fence or not really thinking about buying a home, but given the $8,000 tax credit, some people responded to it, and that bought us some time that once the economy recover, we can have the normal organic growth of home buying, job creation, and more home buying. So home prices at least appears to be stabilizing. There's some indication that at least in the early part of this year, it may be showing some slight modest increase on a month-to-month basis. It is still down from 1 year ago, 12 months ago, but on a month-to-month basis is beginning to show some stabilizing trend. Next slide shows the new home construction market, the housing starts. So again, it shows the cyclical nature of the housing market, ups and downs. One unique part of this aspect is that it's been down and it is refusing to get up. So it's been down for a prolonged period, and it is down much, much below that green arrow line that you see, horizontal line, and then green arrow represent the long-term average, and also based on the 3 million population growth we have in the country and accounting for some of the demolished units, how many new housing we need to build to accommodate the rising population. So one can clearly see that the new home construction market is greatly underperforming in relation to the long-term average. Interesting part is that from the builder's point of view, they would indicate that they would like to build more homes, but they are being constrained because of the very difficulty of accessing construction loans. So one can say that housing start is being artificially suppressed, not by builder's choice, but because of the lending constraints. Moving on to the next slide, which shows the inventory of newly constructed home, and this, interestingly, is at a 50-year low. Any business with declining inventory, you would anticipate some pickup in new production, but builders are not building more because they cannot tap the credit from the bank to build more. Some of the larger home builders who have access to the stock market, they are able to obtain capital and start building, but 80% of home building market is based on the small-time builders who build maybe 5 to 10 homes a year, and they cannot obtain construction financing. So despite the 50-year low on inventory of newly constructed homes, housing start has not come around so far. Next slide shows the existing home inventory. So this would be for resale market, not the newly built. Typically, the new home inventory would represent about 10 to 20% of overall inventory. So the existing inventory is a larger animal, and it is somewhat elevated compared to historical norm, but it is trending in the right direction now at a 6-year low point. So at least it's moving in the right direction. If we go to the next slide, this is something that some people who are very cautious about the housing market recovery always allude to say that, what about the shadow inventory? The visible inventory is falling, but what about the shadow inventory? Well, the shadow inventory one can measure by the number of seriously delinquent mortgages, people who have missed payment for more than 3 months or homes already in the foreclosure process, and it is clearly elevated, but note that it is falling. So it is not the case that somehow visible inventory is falling and shadow inventory is rising. Both the visible as well as shadows are falling. And also the REO, already foreclosed upon, held by banks or held by the federal government in terms of Fannie and Freddie, those REO properties are also lower today than before. So you have a situation where all three buckets of inventory, the visible, shadow, REO, are falling, moving in the right direction. So I am not concerned about somehow the new wave of foreclosure coming down the line, because everything is eaten in the same direction. Everything is going down in the same direction. Going to the next slide, one sees that current home prices are probably properly valued, and if anything, maybe a slight overcorrection. One chart shows the home prices. Other chart, the blue line, is the rent. I'm starting from the same point back in 1980 and growing. Historically, it is 1-to-1 relationship, meaning that rent rises 1%, home prices rises 1%. So given the outside of the anomaly year of the bubble and crash, we are pretty much back to normal. So given the rent increases, we should anticipate home prices to be rising. Right now, rents are rising, but home prices are not rising in any meaningful sense. Next slide. But the encouraging sign is that the affordability is very high, meaning that the mortgage rates are low, home prices are low, people's incomes are beginning to rise, and given the rise in affordability conditions, it's just inevitable there will be pickup in home sales. And in the early months of this year, we are seeing about 10% higher home sales compared to last year. And our realtor members, some of the qualitative data, things as open house visits, the seriousness of the buyers are all indicating that this time around the home buying appears to be much more sustainable. So we do anticipate that home sales will be higher this year compared to last year, about 5 to 10% higher, but it could be even higher. I mean, our members are even more optimistic compared to my official forecast. Next slide. Another factor that indicates that why the home sales will be improving or housing market will be improving is that household formation has been greatly suppressed. In the past 4 years, from 2007 to 2010, the household formation has been roughly half the rate of the normal household formation. And this is something that many of you have personally experienced or know of someone who have experienced, which is that many young adults moving back with their parents or roommates finding that third and fourth and even fifth roommate, but it's just inevitable that some of this crowded-in living will begin to separate. So if one can visualize a spring, a recoil spring being suppressed, is ready to pop out, and given that we have a job market recovery, I think it's just inevitable we go back to normal. And if that's the case, you can have a unique situation of rising home ownership demand as well as rising rental demand. Moving into the next slide. Broadly speaking, I feel very comfortable that home sales will be higher, which means inventory will be lower, and with a lower inventory, prices stabilizing, and the improving factors are job creation, 3.5 million job creation from the low point, stock market having already recovered nicely, the rents rising, that's providing impetus for some of the investors to pick up foreclosed properties. I mentioned about the household formation, and the consumer confidence appears to be coming around as well. So these are a great improvement. And moving over to the next slide, which is my next to the last slide, this is the GDP growth contribution from the residential construction. And what one sees here is that during the housing market downturn, it subtracted GDP growth about 1 percentage point, which means that when you hear GDP is growing at 2%, housing was contributing 1% lower. So without the housing, it would have grown 3 percentage points. The red line that you see is my forecast. So based on increased home sales, housing start anticipated to come around, low inventory situation, that this time around GDP will be contributing to the GDP. Housing will be contributing to the GDP by about 3/4 of a point, so 0.7 percentage points. So without housing, economic recovery will be very sluggish this year, but because of housing, it will be somewhat decent. And moving to my final slide, the forecast chart. I anticipate GDP to be about 2 to 2.5% range, and next year something similar. But by 2014, I think we should be getting pretty much back to the normal 3% GDP growth. In the meantime, the jobs are anticipated to be about 2 million. CPI inflation, I actually have a higher than other economists. The Fed's preferred inflation rate is around 2%. I anticipate about 3%. Rents rising. And the circle item, strong rise in housing start, that is the GDP contributor. So thanks for your patience and thanks for listening.
Thanks, Lawrence. We're going to move to polling question number 2, which gets to what is your expectation for performance and attractiveness of the commercial property sectors for the balance of 2012 versus last year? This is a kind of a tee-up question before Matt talks about his section of this debrief, but do you expect more stress, flat, moderate improvement, robust strengthening, or not sure? And while we wait for your responses, Lawrence, if I can turn to you real quickly, and as you look at the regions of the country and you look at the recovery, which regions do you see being the strongest?
Well, the very middle of the country, North Dakota, South Dakota, all the way down to the state of Texas, right in the middle, the job market is much stronger than the rest of the country. So these market will be strong in the housing as well. But the interesting part is the hard-hit markets of Miami, Vegas, Phoenix, investors are swarming. Inventory levels are back down so low, there's now multiple bidding becoming very common. So price increases of close to 10% may be possible in Miami, Phoenix area before year end, meaning that December to December, it could be a 10% price gain in Miami and Phoenix.
Great. Thanks, Lawrence. Why don't we take a look at the responses to the polling question? Looks like generally either moderate improvement or flat, same as last year. Nobody feeling it's going to be really that robust. Matt, why don't I turn it over to you? You provide your insights on property fundamentals and transaction update.
Sure, Bob. Thanks. As Bob mentioned, I'm going to provide a short update on the M&A activity. I'm going to touch on some of the distressed elements of the market and then cover in a fair level of detail the 5 major commercial property type fundamentals. And so as we move to our first slide, discussing transaction activity, you can see how transaction volume is slowly increasing. And on this chart, we have the U.S. commercial real estate transaction volume by property type from 2001 through 2011. And you can see the ramp up that occurred through 2004, 5, 6, and 7. And then the Great Recession set in 2008 and 2009 with the recovery that has begun in 2010 and 2011. You can see the amount of volatility and uncertainty this has created. There's clearly been a drive towards asset diversification. Recovery in 2009, 10, and 11 that's occurred. It varies by region and by property type. There's clearly been a flight towards high-quality assets in international gateway-type cities. Now, nearly $2 billion of commercial real estate transaction volume occurred in 2011. The first half of 2011 was up about 117% over the first half of 2010, according to Real Capital Analytics. Also, 39 of the 40 top markets registered a year-over-year gain in 2011. So we're seeing all markets come back. Dominant buyers in the commercial real estate markets have been REITs, private equity, and private investors, along with a growing number of institutional and cross-border investors. So as we move to the next slide, I want to touch on a bit of what's going on in the distress portion of the market. New distress additions continue to slow. So this chart has on the vertical axis billions of dollars over a timeline between 2007 and 2012, with the lowest strata being the troubled assets, followed by REO, restructured, and then resolved. So in 2007, there was essentially no or minimal distress. Then new distress additions, you can see, continue to slow. Most distress, CRE, commercial real estate, is held by commercial banks. Troubled and REO account assets topped out in 2010 and are slowly declining. And the pace of resolved and restructured assets continue to increase in 2011 and is anticipated into 2012, which is a good sign. Now let's move to polling question number 3. Polling question 3 is, which property type do you view as offering the most favorable investment opportunity based upon recent performance of fundamentals? Now your choices are office, industrial warehouse, multifamily, retail, hotel, and not certain. So as you answer that polling question, I'm going to be covering those 5 property types and touching upon the volume of transactions by each property type, pricing, capitalization rates, also touching on corresponding vacancy rates and rental rates, along with the amount of development and absorption by property type. The charts and the graphs that you'll see are similar in each of those property types. So let's take a look and see what result we have from polling question number 3. As you can see, multifamily by a large margin is kind of the favored investment opportunity at 59%, followed by office at 16%, and then by industrial warehouse. I think, and given that response, I think is going to be fairly consistent with some of my comments that are forthcoming. So let's move to the office segment. Office demand is improving and continues to build upon the strong rebound that occurred and started in 2010 and 2011. Transaction volume has advanced approximately 77% in the first half of 2011 over the 2010 levels, but at the back end of the year, momentum slowed, as you can see in the chart at the top of the slide. Investors favor high quality, stable properties in major markets such as Boston, Washington, D.C., New York, San Francisco, Los Angeles. But at the back half of 2011, some of the other inland cities such as Denver and Phoenix monitored some good volume as well. Average price per square foot has been mostly stable in 2011, around $210 to $225 per square foot. Average office cap rates fell in the first part of 2011, but started to stabilize at the year end of 2011. The average cap rate in Manhattan was 5.7%, or about $409 per square foot on pricing. And in Washington, D.C., the average cap rate was about 5.9%, or about $500 per square foot. Let's move to the office fundamentals. As we can see, they're starting to stabilize, and office vacancy started to decline in 2011 and is expected to improve further in 2012. Generally, demand for office space is moderately strong, essentially no new development or new completion. However, just released yesterday, Manhattan office leasing has seemed to soften a little bit in the first quarter of 2012. If you look back, office vacancy was about 17.1% at the end of 2011, down from 17.6% at the end of 2010. And it's anticipated that office vacancy will decline to about 16.6% in 2012. Also, Class B and Class C properties will continue to be tenant markets in 2012. Class A rental rates remain mostly flat with slight upward increase forecasts. Absorption remains positive, starting to see sales and activity shift in secondary and tertiary markets. So let's move to our next property sector, which is industrial property. And you see the demand continues to grow in 2011 as the manufacturing sector has been focused on rebuilding inventory, and international trade has driven much of the demand in 2011. Sales of significant industrial properties increased about 74% in 2011, really dominated by institutional and private investors. The merger between A&B and Prologis added more than $8 billion to total volume that occurred in the second quarter of 2011. However, momentum began to slow in late 2011. Investors favor major industrial markets. Chicago was the largest by dollar volume in 2011, followed closely by Los Angeles. Cap rates fell modestly in the first part of 2011, averaged about 7.9%, but still relatively high compared to the other property sectors. Also, cap rates are lower in the western markets within the United States. Industrial properties make up the lowest percentage of distress properties compared to other property types that are currently in distress. Let's look at industrial fundamentals. Industrial vacancy dropped to about 9.8% in the second quarter of 2011. Further declines are expected into 2012. With a net absorption of about 100 million square feet anticipated and about 15 to 20 million square feet of new products to be completed. Net effective rents have stabilized and are expected to increase slightly at about 1.7% in 2012. Downside risk to this property sector type is high fuel prices, Mideast unrest, and high unemployment. According to Grubb & Ellis, by the end of 2012, overall vacancy could drop below 9% in 2012. Let's move to our next property type, which is apartments. Apartment volume and pricing improve. Building upon the 2010 momentum, apartments have been one of the strongest performers in 2011. Volume of transactions increased throughout the entire year and was up considerable by the end of 2011. And the sales volume in the fourth quarter in 2011 was $16.6 billion alone. As you can see in the bar chart, there's been steady increases in volume since the first quarter of 2009 in this property sector. Record high prices set in some markets are surprising some in the fourth quarter of 2011, such markets as Austin, Oakland, and Seattle. Cap rates continued to compress in 2011. If you were to look back to second quarter 2010 compared to the second quarter 2011, you would see a compression of about 32 basis points decline, and that decline continued throughout the year. Cap rates for garden apartments are generally about 100 basis points above mid and high-rise cap rates. And another interesting fact might be that in 2011, 10% of the apartment properties traded at a cap rate of 4.7% or lower. Let's move to the fundamentals within the apartment sector. 2010 was likely the strongest year in apartments in the last 15 years, and 2011 was even stronger yet. And many of the employment gains in the 20 to 34 age group is a key renter demographic, has driven a good part of this. Renters are moving in at higher rental rates with fewer concessions. Effective rental rates increased by 5.1% in 2011, and vacancy rates declined to below 6% according to Axiometrics. As seen on the graph on this particular slide, you can see the vacancy rate is continued to decrease and projected to decrease, and rent growth is projected to increase. Also, in our annual document, the Expectation of Market Realities report, we include a forecast of effective rent growth and vacancy through 2015 by major markets. You may want to reference that for more detail. Let's move to our next property type is retail demand is up in 2011. Consumer prices were up by approximately 3.8% before seasonal adjustments, with unemployment declining to about 8.5% by the end of 2011. Overall retail property volume was up about 90% in 2011 from 2010, and the amount of volume that occurred in 2011 was about 3,400 significant retail property transactions, with the Blackstone Centro deal happening in the second quarter of 2011 being the largest. We're also seeing institutional REIT demand causing price divide between large and small properties. And at the end of 2011, average price was approximately $180 per square foot. Cap rates are down for grocery-anchored centers that continue to perform strong. On average, the cap rate was about 7.6% as of the fourth quarter of 2011 on an aggregated basis. So if you look further at the retail property fundamentals on the next slide, since the Great Recession, the retail recovery has been very uneven. Anchor neighborhood centers that are serving A mature market with high income trade area and demographics have performed very well. Retail vacancy is set to retreat slightly or modestly. Downward pressure on rental rates, averaging just over $19 per square foot. Retail sales and consumer spending, along with consumer confidence, improved in late 2011 and continued and is continuing into 2012, helped by the strength of the general equity markets. As you can see on the slide, the graph on the lower portion of this slide, the retail property absorption is forecasted to increase, and completions are continuing to decrease. Let's move to hotel, our last property type. Hotel properties demand is recovering. Listed REITs has been the most active. Institutional and cross-border investors have focused on this property type in terms of picking up trophy assets. Hotel volume and pricing increased in the first half of 2011, but began slowing in the fourth quarter of 2011, as you can see in the top chart on this slide. Full-service average price per key increased to $175,000 in 2011, and cap rates increased in early 2011 and continued to decline for the balance of 2011 for hotel properties. As we move to look closer at some of the hotel fundamentals, you can see that there's been positive but moderate growth. Occupancy and RevPAR increased in 2011, as did ADR. There is forecasted growth in occupancy and RevPAR in 2012, as you can see in the hotel fundamentals chart on this slide. And year-over-year change in RevPAR is forecasted at 7.3%. So I'll move now to summarize the 5 property types. When you look at the 5 types we just covered, for office, fundamentals are gradually improving. Transaction volume is up, including secondary and tertiary markets, but sales begin to slow at the end of 2011. Industrial, sales increased in 2011 but slowed at the end of the year. Rent expected to increase slightly in 2012, and vacancy in industrial space may drop below 9% on average in 2012. In the retail sector, demand by institutions and REITs for large grocery-anchored centers continues to increase, and there continues to be absorption that is forecasted at a low level of development projected. Apartments have been kind of the darling. Demand remains high, with record high prices in some markets, especially for those mid and high-rise type properties. And then the hotel component, growth and volume declined in the fourth quarter of 2011. Risk is increasing. Moderate growth in occupancy and RevPAR is expected and forecasted for hotels. So with that, Bob, I'll turn it back over to you.
Great. Thanks, Matt. Before we move into the capital markets part of our presentation, let's ask a polling question around the capital markets and the outlook for capital availability for commercial real estate in 2012 versus last year. So as you take a look at our potential answers here, do you expect tighter standards and less availability? Same standards, to some extent, the bifurcated capital markets we're seeing today, where those that have get access to capital. Do we see expanding capital reaching out to riskier positions, or too much capital resulting in broad market aggressive pricing, or not sure? I mean, capital availability has certainly improved since the dark days of 2008 and 2009, but not without some unexpected developments and momentum-breaking challenges. Public REITs have been able to raise significant amounts of public debt and equity capital, and there are significant amounts of private equity capital available to deploy in commercial real estate, but many players are having challenges getting to that capital. And so in a moment, we'll have Ken provide his viewpoint on the capital markets and the outlook. But why don't we do this? We take a look at the responses to the polling question. It looks like the popular answer is same standards as last year, that we'd see a continuation of the bifurcated capital markets. But then some see expanding capital markets, and not a insignificant minority see tighter standards and less availability. So Ken's presentation, I think, is going to be pretty enlightening. Ken, can I turn it over to you?
Yes, thank you very much, Bob. And as the first thing I like to do is look at, the financial markets. And my, role today is to tie together what Lawrence talked about and what Matt talked about regarding the economy, the property types, what's going on. And in the end, I want the listeners to formulate themselves, what is the outlook? What is the short and long-term outlook for commercial real estate? And as we look at the financial markets, I think it's an important area to examine, because it's going to tell you how attractive is commercial real estate. And what I would point the listeners to look at in private and public real estate in the chart for fiscal year 2010, 2011, you can see compared to the other investments, they provided very strong returns. And also along with those returns, post-credit crisis, to me, what's very important is commercial real estate is giving investors something they want. And what they want an asset class that is tangible. They want transparency, and they want to invest in something that they understand and they can trust. I view that's one of the most important results of the credit crisis that we went through. And so when you look at it, real estate's providing not only performance, but those investment characteristics. We have to remember, when you look at interest rates today, 10-year treasuries are at 2.2, 5-year 1.05, 2 years 0.34. Think about that relative to what commercial real estate can provide. Now, I would point on this slide is that now the trajectory is changing. Look for fiscal year 2012 when you look at the stock market is starting to come back. And what we need to examine is what will that mean? Because the commercial real estate is connected to the capital markets. So what we want to do is then, delve a little bit more into what's happening. And if you look at REIT fundraising for 2011, you'll see that one, I would look at the chart on the left, and you can see what I'm really amazed at for the fundraising for public REITs in fiscal 2011, it was at the same level pre-credit crisis. I think that's a major message, to the marketplace, to the capital markets. Now, you can see in this fiscal year 2012, it's starting to decelerate, but it's still at a very robust pace. So, and I look at it and I say that the capital markets are sending a message. They do like commercial real estate, but it's becoming at a decelerating level, and you saw the performance was coming down. And now if we examine the entire lending environment, you look at who are, the individuals, the banks, the life insurance companies for originations and the fixed income lending environment. If we turn to the next slide, we'll see that the total fixed income market is roughly $3.07 trillion. And what's important is the banks have 43%. I mean, that percentage really hasn't changed a whole lot since we've been tracking this for many years. You see the life companies have about 10%. CMBS market, through the credit crisis the past 10 years, they became a very significant influence. You can see represent approximately 20% of the $3 trillion pie. What I would tell you that the lending environment has stabilized, that I never viewed that the environment wasn't a liquidity issue, it was a pricing issue. There was plenty of capital, both equity and debt, post-credit crisis, but it was very discriminate capital. And what I'd point out on this slide, what we see happening is we knew that there was a flight to big quality assets. There was a lot of lending, there's a lot of equity, but the pricing on that from a lending standpoint was still very expensive relative to 10-year treasuries. What we've seen recently, though, is that the pricing for those top quality assets have lowered by 150 to 200 basis points just in the last 6 months. More competition. There's still a bifurcated market, and what I would express to you is that I think that's the first sign that once that compression happens at the quality level on rates, you're going to see individuals reach out on the spectrum to start making lending. They have to make money. It'll become a competitive environment. And as you look at the CRE maturities and, as we go through the next couple years, you can see this has been one of the most critical issues watched by investors. And I would say that the concern, the level of, I would say, angst in the marketplace has lessened, and the reasons why are, ironically, how slow the recovery is happening in all facets. Ironically, the slow growth rate and the slow transition that we're experiencing allows things to work in a more fluid manner. Because in the polling questions, I found it very interesting that basically 71% either said it's going to be a gradual or flat recovery. The same thing for performance. If you look at performance, moderate and flat responses were 91%. And as we go through this for these maturities, that becomes a very important element for the ability, as you see, the modifications that will need to take place as we go forward. Will the lenders be willing to do that? As we look at capital availability, this is a chart that we've been monitoring, and I view that it's one of the best pulses. One of the best things that we watch is more the sentiment. And as you look at this, you'll see the lighter line is the availability of capital. And why I point to that, look at when it peaked, roughly right before the credit crisis, roughly the mid and end of 2006 it peaked. And this was availability of capital, and then you see the availability in 2008 hit rock bottom. And why I'm watching that is you then see the trajectory, it accelerated, and that also ties into the value recovery that we saw for commercial properties, and you saw the discipline there was at its lowest point, at the point that there was too much capital, and today what we're starting to see is there is concern, and that was another interesting thing for the polling questions, is that basically 46%, roughly half said it'll be the same, 29% said capital will be expanding, and there was a small percentage, if you look at it, total was 80% same, expanding, or too much, and that's the same thing that these investors are saying. This is based upon polling roughly $500 billion worth of capital each quarter, and you can see we've been monitoring it, but a nice thing, it's now come down a little bit, that there is, again, you want to match discipline to capital availability, and this, again, bodes well for commercial real estate. If we then turn to investment recommendations, you can see that we are, seeing a nice fluid market. What you want aligned, as you can see, contrast, right now there's an alignment of buy, sell, and hold. This is interviewing $500 billion worth of capital and asking, what do you view? Is it a good time to buy, sell, or hold commercial real estate? And you can see fourth quarter 2008, that very dark line was sell, do not sell. Today you see that it's roughly even with what the recommendations are, and that's a positive sign. And what I'm going to lead to is, where do we go from here? So we have one is, it's not a liquidity issue, it's a pricing issue. We now have capital availability that is disciplined relative to what we've seen in the past, and now we see a more fluid market. Then, as we look at the cap rates for properties and the spread, I think this is one of the most important stories. As I started out, what do the capital markets tell us? To me, this is an important story. This is the spread of commercial real estate versus 10-year treasuries. And as I look in history, these indications are very powerful. Look at in the chart, if you look at basically first quarter 2007, prior to the Bear Stearns failure in the spring of 2007, 2008, you can see that the spread was the lowest we've ever seen it. Then during the credit crisis, it spiked. Think about it. Commercial real estate on an income basis was providing almost 600 basis points. That's the cap rate. Total returns were probably 800 basis point spread. And then you can see as we've gone along, bringing us up to the current date, there's still a very attractive spread. So we're pulling together the argument that commercial real estate, one, it's tangible, it is transparent, it's understandable, and then on a risk-adjusted basis, it offers a very attractive return. And it offers one of the important parts of the return is the income component. So it offers that to a marketplace that is much more income driven. If you look at the environment today, the market is saying, I want income with a little bit upside. It's not only the risk aversion, it's the demographics that we see in the world today. As we see the aging baby boomers move into retirement, they're going to seek income products. They're going to seek products that, in fact, have a lot more safety and a little bit upside. And that brings us to the last slide is, where then are commercial valuations expected to go beyond this point? I know this slide looks a little busy, but if you look at it and you have a chance, it's very important. The very dark line is showing, you know, the lighter line going back to the beginning is showing what happened in the 90s when we went through that cyclical downturn. And it took roughly 6 years to go through the downturn. This downturn, even though we faced the worst credit crisis we've seen in our lifetime, the property values dropped within 2 years, and we've recovered. And to me, that's a testament then to the maturity of the market, the credibility of the marketplace, and then our forecast, as you can see, is that we predict, we call it, it's the NACREIF, which is the National Council of Real Estate Investment Fiduciary Total Returns, which is the income plus depreciation. We view, from our perspective, is that it'll be roughly 8.5%. This coming year, which is, if you want to break it down in a simple formula, it's probably 6% income, 2.5% on the appreciation side. So I would close with saying that I view commercial real estate from a return perspective, from an investment alternative perspective, and just getting it right is in a better position than I've ever seen in my 30-year career. As we all know, the big institutions got into commercial real estate in the late 70s, roughly 35 years ago, and they got in for the reasons I talked about, but they were disappointed along the way. Transparency did not materialize. The understandability or expectations weren't aligned, but I view that we're there today. I would also then say there's still a bifurcated market. We still have the trophy properties that trade at a certain volume, a certain price, and a certain cap rate, and then we have the tertiary markets that still are not, you know, I think, ventured into by many investors, and I see that changing. I don't see that as a bad thing. So my view, I'm more bullish on commercial real estate for all the reasons about the slow growth, the stock market volatility, bond rates being the lowest we've ever seen in a generation. I'm more bullish on, again, a very modest pace for commercial real estate than I've probably been in my career, but it's very modest. It's going to be a very slow recovery across the board, and that's what I think basically, if you look at the polling questions of, I think there's roughly a couple thousand listeners on here, it's very consistent, and that's what our view is. So with that, Bob, that's, you know, I hope that's a good story for those that are listening, but it's a tough road. It's not a simple process. There's a lot of challenges as we go forward, but we're through the worst part of it. So with that, Bob, I will turn it over to you, and again, from my perspective, we appreciate the opportunity to present to everyone.
Great. Thanks, Ken. Very interesting and insightful. Let me turn to polling question number 5, and then we'll move to Q&A. To what extent do you expect commercial real estate values to change over the next 12 months? And we've got a range of potential answers here. We're looking forward to seeing your response. But while we wait for that, we've got a bunch of questions and big audience today, and an Outlook always generates lots of questions. Let me turn the first question to Lawrence. Lawrence, we got a number of questions in around the availability of residential mortgage debt and the impact that could have on any sort of recovery in the housing market. Given tighter underwriting standards, more people not qualified to get mortgages, the impact of foreclosures, what do you see in terms of that impact on the housing recovery?
Very good question. First, let me clarify about the builders and the construction loans. Construction loan does not have government backing, so it's much more difficult. On the residential mortgages, it does have government backing on most loans, FHA or eventually Fannie and Freddie. So the degree of accessibility is a little better on the actual home buying. Now, having said that, if one looks at the credit scores of those people who are getting approved for mortgages today, it is significantly higher today versus, say, back in the year 2000. 2005, it was an anomaly, stated income, all false records, so those don't count. But if one compares credit record of today versus the credit scores of back in the year 2000 when people were not discussing any bubble or crash, today represent about 15 to 20% of population who would have qualified for mortgage in the year 2000, but not today. Another way to, yeah. So that is holding back the market recovery.
Thanks, Lawrence. Ken, let me turn one to you real quickly. There was a question around how do you measure the discipline of capital? How would you characterize that?
Yeah, it's interesting. It's a sentiment survey. We have found, actually it was in the last cycle, we asked the question specific to investors to give us a scale on 1 to 10, what is, the discipline of capital, and the next question that's asked is what is the availability of capital. And we've also checked that against then to the capital flows, and you can see in the chart that we provided, it is a very good barometer, actually a more real-time barometer. So it's a sentiment survey based upon interviewing roughly 50 major institutions in the United States on a quarterly basis.
Great, thanks. One other quick question for you, Ken. Your sense around the impact of potential future interest rate increases on the recovery of real estate, right, commercial real estate. So I think there have been some indicators over the past couple months of interest rates beginning to tick up. Any thought on the impact that will have?
Great question, Bob, and I would say to me that is the greatest, let's call it, risk that commercial real estate faces going forward. And I think all of us have watched and said, how can they stay this low for this long? But the markets are saying they are going to. But I guess I would respond by stating that if it happens in a measured pace and the economy grows along, if the results of interest rate rises are with economic expansion, which drives rental rate increases, we should be okay. But it is the greatest risk that commercial real estate, faces, because if that expands too quickly without rental growth income, that means values are going to drop. You're going to have cap rate expansion while you have static income. So it is a risk. It is what watching, but many have resolved themselves to say, look at these rates and how long they've been. So I think outstanding question, and it is a risk.
Lawrence, let me ask you a quick question. As you take a look at markets that did not decline as much as other markets, and one market that comes to my mind, for example, is Dallas, where the Case-Shiller Index was actually relatively flat over the past several years. What have lessons been learned around that at all? Any sort of drivers around that?
Well, the areas, or I call it the region between the mountains, between Appalachian and the Rocky Mountains and all in between, the building, the home prices tends to be much more stable. It's the coastal regions where things to be much more volatile, partly due to some of the land restriction use. And when the demand rises, the inelastic supply basically pushes up the prices. One unnatural market, and I'm scratching my head over, is Atlanta. Atlanta really did not have a big bubble, but their prices are crashing even to this point, which is interesting as to why that is occurring. But generally, the middle America, where land is plentiful, and I think people in general tends to be a little more conservative in terms of their buying habits as well. So it's much more moderate swings in the middle of America compared to the coast.
Very good. Thanks, Lawrence. Well, we're about out of time here. Just to circle back to that last polling question, the theme of moderation comes through again. The majority of folks predict moderate improvement, and over 92% predict either minimal or moderate improvement. So with that, I'd like to thank our presenters today, Lawrence, Matt, and Ken, as well as our audience for joining us today. And join us on May 3rd for our next real estate series, where we talk about the great European shakeout and the impact of the debt crisis in Europe on real estate. So thanks again, everybody, for joining us.
Thank you, Bob. Thank you, everyone. Bye-bye.